Thank you and good morning. I've got 20 minutes to talk about making telematics a mass market proposition. Although one of the advantages of going first is that I can say pretty much what I like and nobody else will have said it yet. So apologies if I veer off topic slightly, but I'll try and stick to the brief. So first of all, I suppose, how would I characterise the current state of the market? Well, there's an increasing number of providers in that market. A number of logos there from the early adopters, perhaps somebody like Coverbox, mileage-based product, launched, I think, back in probably 2009. Insure the Box, 2010. Ourselves, Co-operative Young Driver, in March 2011. More recently, I seem to read in the trade press every couple of weeks about a new provider coming on stream with some form of telematics offering. So lots of providers out there, and I'm sorry if I've missed your brand off there. Lots of providers, lots of high-profile advertising, particularly from the likes perhaps of Ingenie with Gary Lineker. But what I would say is perhaps lots of specialist brands, quite a lot of intermediated offers. Not much in the way of direct insurers there yet. So increasing number of providers, but generally low volume. So probably with the, I think Insure the Box probably have quite a relatively large number of policies, but most of those other providers on that previous slide perhaps just have a few thousand or even a few hundred in some cases policies live. And it's very much targeted at niche markets, so most of those providers aiming at young drivers, inexperienced drivers. A couple of reasons for that. One, that's probably where you get most variation in claims experience between the good, safe drivers and the poor, and therefore that's where telematics has most to offer in terms of differentiating between those good and bad risks. And also, that's the high premium end of the market where the economics stack up best for this type of offer. But very much targeted at niche markets. So I would say perhaps those young and inexperienced driver markets perhaps amount to perhaps 10% of the market. So if I think there's 26 million private cars on UK roads at the moment. Perhaps those niche segments amount to a little under 10% of that. And telematics penetration of that market, again, I would say probably 10% at most. So probably only a little under 1% of the market, probably less than 200,000 units in the market at the moment. So when will telematics become mass market? I suppose first of all we need to decide what we mean by a mass market proposition. And I suppose there's two elements to that. There's when it expands beyond those niche segments, younger and inexperienced, into more mainstream markets, and when it achieves some sort of critical mass in the market. So perhaps the sort of thing I'm looking at would be, will telematics achieve perhaps 10% market penetration, a couple of million policies in sort of 5 years' time? So what's preventing telematics becoming mass market today? We all seem to think telematics is a good idea. The next big thing in insurance, certainly the conference producers do, from a number of these things that I'm either asked to speak or asked to attend. So if I come back to a sort of economic model of supply and demand, so I think there's supply factors, why telematics isn't yet mass market proposition, and I think there's demand factors. And we'll explore some of these in a bit more detail over the next few minutes. So on the supply side, as I mentioned, a lot of the brands there at the moment are relatively small specialist brands. Many of the big insurers don't have a product yet. Perhaps for varying reasons, the likes of Aviva were obviously very early entrants back in was it 2004 with the original pay-as-you-drive policy, and perhaps got their fingers a little bit burnt on that and have perhaps been slightly slow coming back into the market. It does take quite a while to develop one of these products. So from our own experience at the Co-operative, I think it was about 18 months from concept to launch, even though we already had quite a lot of the underwriting data we needed to price that business. I think cost is an obstacle for some of these big insurers, both in terms of the development of the project to get live and the cost of the technology when you're live. And obviously, we all know insurers have myriad other priorities, not least sort of regulatory, Solvency II and those sorts of things. On the demand side, I think in the early days there was perhaps a lack of awareness amongst potential customers of what telematics could offer them. Many perhaps just didn't know about telematics. I think that is changing. There's been a lot of publicity around telematics offerings. I saw a recent survey from Towers Watson that said 84% of people would consider a telematics offering if it reduced their premium. So I think there is increasing awareness. I think people there have been some concerns around privacy, which I'll come on to in a minute. And then finally, is the price saving enough? So ultimately, does it just come down to money? And if telematics can offer someone a cheaper price, they'll take it. But if it can't, then they'll stick with a conventional product. Thank you very much. So let's look at some of those elements in a little bit more detail. On the supply side then, many big insurers, as I said, don't have a product yet, and that brings a couple of issues with it. Firstly, those big insurers are the ones with the big marketing budgets that can really raise the profile and awareness of telematics. And secondly, they're also the ones probably with the greatest economies of scale, the best expense ratios, so that if they are to launch a product, then it's likely to be amongst the most competitive from a price perspective. But I think that is changing. Many insurers have schemes either in development or perhaps in pilot phase. So perhaps over the next year or so is going to be a big one with lots more schemes and lots of bigger insurers coming into the market in a full scale way. And aggregators are starting to tap into this market and see the potential of telematics as well. Compare the Box, hosted by Go Compare, is probably one of the at the forefront of this, and also Confused has recently launched a TV advertising campaign specifically around telematics. So there's a lot of interest there, both from insurers and aggregators sort of feeling their way, a feeling that there's I suppose, to put it simply, there's money to be made here from a commercial perspective if sufficient awareness can be raised among customers. On the demand side, I think customers do have valid concerns around privacy and data usage. This is very personal data we're talking about. The telematics box can record where somebody was at any given time. And I think people have two concerns around that. One is kind of data security perspective. What happens if this insurer loses my data? It obviously depends whether or not you've got something to hide, but I guess the majority of people wouldn't want it to be public domain information where they've been at every moment of the day. And secondly, how the insurer themselves will use that data. So will the insurer, one of the questions we're often asked is, will you use this data to avoid paying out on my claim? Will you pass this data to the police in the event that I'm caught speeding? Those sorts of questions. I think those concerns probably are diminishing over time as people become a bit more used to the concept. And I think perhaps also people become more used to the fact that they can be tracked already through other technology, perhaps through a mobile phone. If somebody really wanted to find out where they were, that tracking capability already exists. It's not unique to an insurance telematics product. And I think that particularly amongst young people, perhaps these concerns aren't as important. Perhaps the older generation looking into breaking into a mass market might have more concerns around some of this. But I think the market is in a fairly, a slightly precarious position, I suppose, that one rogue action could set the market back years in terms of one high-profile insurer perhaps turning down a claim because of something the box showed about what that customer was doing, were they driving too fast or whatever. One data security breach leaking some high-profile data into the public domain. Trust is very important, and I think it would be very easy for one sort of rogue action or one mistake to breach that trust and set the market back a long time. I'm often asked about data standards in telematics, in terms of should there be common standards across the market, across insurers. In terms of this presentation, mass market telematics, I don't think it's a driver for uptake. I think at new business stage, customers generally don't think about it and don't care. But looking forward, a lack of portability of data could stem the growth. So if somebody's got a telematics product, when they come up to renewal, what they really want to be able to do is to carry that driving history they've built up, the benefit of their safe driving record, to another insurer, to gain the benefit of that in their premium with another insurer, not to have to fit a new box every year at renewal. So I think those are some of the problems the industry is going to have to wrestle with if this is going to become a mass market proposition, that there will be a retention impact if we can't address some of those questions to meet the customer need, really. So I've kind of skirted around a few of the issues, but let's start talking about money. This is in many ways the overwhelming consideration here. I've got a statement there that most people would consider taking a telematics policy if it saves them enough money. Our market research in the cooperative insurance, when we were looking to launch our young driver product, so probably back in 2010, our customer research found that yes, people were concerned about privacy, people were concerned about what we were going to do with the data, but if they saved enough money on their premiums, that sort of miraculously overcame a lot of those concerns. And the key figure in those days seemed to be around about £300. So if somebody could save £300, then quite frankly, they didn't care what we did with their data. They'd take that money and run. Actually, I think if anything, as people are becoming more used to the concept, that figure's probably coming down. So it's probably less than £300 today. But if we consider some simple sort of mathsy examples, can't get the actuary out of me, I'm afraid. So consider a young driver policy. A standard non-telematics policy, that premium might be, let's say, £2,000 for the sake of example, and there might be a 75% loss ratio on that, so there's £1,500 worth of claims on that policy, and obviously some expenses, some costs, and for simplicity, let's assume a break-even underwriting result. With a telematics policy, on the claims line, we might see a decent claims saving there. So I built in there in this example a 30% saving on the claims line. A number of reasons for that. So at this stage of development in the market, there is a self-selection effect. The best risks pick these sorts of policies. Maybe there's a bit of genuine improvement as we incentivise people and educate them to drive more safely. And maybe there's a bit of a saving from claims handling, using the actual data to improve the claims handling. So 30% claim saving, that's quite achievable. But costs will be a bit higher. So there's the box costs. At the moment, it probably costs something of the order of £200 typically to pay for the device and the installation. That can be spread, obviously, over the lifetime of the policy. You probably don't have to do it once. So maybe you can spread that over 2.5, 3 years, depending on what the retention rate looks like. So I've got a figure of £85 a year in there. And other admin costs will be slightly higher than normal, so probably paying a bit more for specialist claims handling skills, analysing the data, the pricing teams to look into that sort of stuff, and so on. So costs are a bit higher. But on that simple example, we can afford to give a premium discount of £300 there, so rather than £2,000, we're charging £1,700. Customer's happy. And we still get a slightly positive underwriting result, so the insurer's happy as well. And obviously there's different balances there in terms of how much profit the insurer can take versus how much discount they're prepared to give to the customer. Now let's look at a slightly older driver. So again, a standard non-telematics policy, perhaps with a premium of about £800. So it's still not true mass market. That's higher than an overall average in the market, but heading down that way. So still 75% loss ratio, 25% expense ratio, still a break-even underwriting result on a standard policy. I've still assumed that 30% saving on claims, but obviously the starting number was much lower, so that only amounts to £180 saving on claims in this example. So the extra costs still exist. So in this example, we can only afford perhaps a £50 discount on that customer's premium. The customers, in all honesty, perhaps not that excited about saving £50, given some of the other concerns they might have. And the insurer's not making any money either. So £800, in my experience, is probably about the limit of where the economics break down on the current telematics model. Higher than that, you can probably make some money. But in order to get into true mass market, £800 is probably about the threshold of where it makes sense at the moment. So how do we make the economics stack up? Well, there's several ways of doing that. We could achieve greater claims savings. That'd be nice, wouldn't it? We could achieve lower costs. Or we could reduce how much the customer expects to save. So rather than that sort of magic figure of £300, that's the customer's threshold, could we find ways of reducing that? So I'll look at each of those in turn. Thinking first of all about greater claim savings, that is possible. I think telematics brings with it a wealth of pricing data, which probably nobody's doing more than skimming the surface of at the moment. So we can find ways of learning more from that data, matching the pricing better to the risk, and identifying ways of finding better risk segments and cheaper claims costs out of that. Better risk selection, though, reduces the target market effectively. The more you cherry pick the best risks, the fewer of them there are. Driver education, I'm a firm believer that telematics can help to incentivise and educate drivers to genuinely improve the risk. So yes, a lot of what we're seeing at the moment in the market is self-selection effect. I think there is a bit of genuinely improving the risk as well. And gender directive, I'm not going to talk a lot about gender directive. I think there's a presentation on this in more depth later on. But if at the moment that the blue represents a young male premium and the arrows represent a range, so around that average claims cost, there's perhaps a range between the best and the worst. And perhaps the best drivers there might expect a 30% or so saving. Similarly on female. By the time come this December, we've taken an average price. We still have the same range from the best females up to the highest males, but from that average price in the middle, that's now perhaps a 45% saving for the safest young females. So it becomes more worthwhile for them. So higher savings for this segment, but it's still a young driver segment, primarily where gender makes the most difference. Doesn't really move us into mass market in a big way. Although I think there is a benefit in terms of awareness from the greater PR around telematics following gender directive. So what can we do to reduce costs? We've looked at what we can do on the claims side. There's a bit, but perhaps not enough. So options to reduce cost, where we can reduce the unit cost, and perhaps the obvious way to do that is looking at options around the telematics device. Or we can increase lifetime and give us more time to spread that over, and that's about retention. And actually the early experience of ourselves and others in this market is that retention on these policies, perhaps due to the premium savings we're able to offer, retention is very good. In terms of the devices, most insurers at the moment probably go for the professionally installed option. Top left picture there, the traditional box. Engineer goes out to install that box. There are variations on that, so I think AutoSaint, rather than sending engineers out, use the Whole Foods network instead. But that's probably the most expensive of all the options. Top right is a plug-and-play device, so very popular in the US, and probably a couple of years ago there was lots of talk in the UK about these. They are a bit cheaper, and they come with all sorts of concerns around: will the customer fit it properly? Can we trust them to do that? Can we be sure they've fitted it the way they're supposed to, and so on? So, I think talk in the market's probably moved away from those a bit over recent times, and perhaps more towards smartphone apps. So a couple of high-profile launches very recently from Aviva and Confused. Now these are much cheaper in terms of the cost of device. Question marks, I suppose, over whether they're sufficiently robust. Can you be sure the person's got the phone in the car they're supposed to have, that it's switched on when they're driving, and so on. But there's ways to overcome some of that. I think probably we'll end up in a space where there's different solutions for different segments of the market. So perhaps a young driver, high risk, high cost segment, we can afford to stick with perhaps the most robust option in terms of the professionally installed devices. As we move mass market, perhaps we've got to look at slightly less robust options, but ones where the cost is cheaper for those less risky drivers. Longer term, there's probably a move towards original manufacture installation, not least with the introduction of eCall European legislation from 2015 that all new vehicles have to have telematics devices fitted. I think from an insurer point of view, the big challenge to that is ensuring that those devices are suitable for insurance use and that they're not simply there for emergency call and nothing else. Even then, even assuming those devices are fit for purpose, it probably takes 10 years to roll out to reach a majority of the vehicle park. So this is a kind of long-term thing. So the final way of making this stack up probably is to reduce customer expectations of savings, or probably I should say change customer expectations rather than necessarily reduce. So over time, there might be an increase in conventional product prices. So as telematics gains critical mass through a self-select effect, the ones who are left on conventional products are perhaps the worst risks, and standard prices will go up, making telematics more attractive. There's a bit of chicken and egg there, that you need a bit of critical mass in telematics to make that cycle go round. But is there something else we can do? Are there added value propositions that insurers can look at to shift the customer focus away from price? And I think there are a number of things we can do, whether that be focusing on fuel economy, perhaps live traffic updates, breakdown diagnostics, emergency call, driving hints and tips to become a safer driver, carbon emissions, vouchers for your next service station, cost of coffee as you're driving along the motorway. That's I think some of you might know Steve Duran from Tracker. That's his pet idea. Or perhaps supermarket vouchers for the shop you pass on your standard commute home. There's a wealth of possibilities here for that telematics data could be put to use to create added value for the customer. At the moment, I think insurers are probably focused almost exclusively on the price savings that can be offered, but there's a lot of other opportunities that perhaps can add value for the customers. So very briefly, to sum up, what does the future hold? Well, I don't know. I think the next year is a big one, both in terms of supply and demand. So I think there's a lot more insurers coming on stream with increased supply. I think there's also increased demand, not least from the gender directive at the end of this year. I think if telematics is going to become truly mass market, yes, technology costs need to come down. We need to find ways of reducing those costs and making the economics stack up. But I think there's also something to be done in terms of insurers focusing on dynamics other than price, some of those value-add propositions. So I think telematics is part of the future. I think 10% of the market within 5 years, and spread not quite as niche over more mass market segments is a realistic ambition. Whether or not that 10% constitutes mass market, I'll leave to you.